What do you think will drive a surge in Tesla stock price? Without a doubt, during the past year, Tesla stock has underperformed, and it appears that this pattern will continue. But there are still a number of, if you still have hope for the leading electric car manufacturer's future, you wouldn't want to miss this. James Stevenson, well-known analyst, shareholder, and participant Tesla Twitter community, recently shared his positive projections for Tesla in a lengthy conversation on Twitter. Stevenson stated, "I hate to break the news to anyone who was hoping that Tesla's recent steep price cuts will open up any opportunities for earnings growth in 2023. In 2023, record-breaking quarterly earnings and deliveries are still expected." Then he went on sharing other tweets in your Twitter thread that included graphs and explanations of his viewpoint, stating that Q3 and Q4 deliveries both fell short of analyst projections due to Tesla slowing down the wave of delivery. As a result of the ongoing price cuts, Tesla is assured of breaking quarterly records for S3C deliveries. Stevenson claims that Tesla manufactures the Model 3 and Model Y, the two luxury vehicles that sell the best around the globe. Sales of the Model 3 are rising, but not as much as those of the Model Y, whose output at Tesla's two recently completed facilities is predicted to reach 3,000 vehicles per week by 2022. Stevenson later tweeted a graphic containing delivery and production numbers linked to the above chart, which showed that since the Austin and Berlin plants started running capacity, production had grown dramatically. Stevenson predicts that as ending inventory levels grow and the average cost per delivered car rises from mid-2022, mid-2023, the solid red line production will outpace the dotted white line deliveries, resulting in increased profitability. The Tesla analyst also said that investors value earnings growth over profitability. Elon Musk, the CEO of Tesla, stated during a conference that the company's fully autonomous cars would be on the road by the end of 2022. Tesla's head of investor relations, Martin Vicha, added that the business was on schedule to produce fully autonomous vehicles under supervision within Musk's anticipated timeframe. On the basis of this supposition, I predict that Tesla will increase profits over the next years by convincing enough customers to pay more for fully autonomous vehicles over the course of the next few years. As Vicha said, drivers will still need to pay attention to the road and follow safe driving practices when Tesla begins to widely distribute completely autonomous driving near the end of the year. In essence, supervised FSD is supervised autonomy in which the driver maintains active control over the vehicle's motion. Referring back to a different chart from the previously stated Twitter thread, Stevenson provided his revised chart illustrating the revenue sources for Tesla on average in addition to his projection for Q4 of 2022. Vita made a suggestion that users of FSD who drive carelessly would no longer be able to use the service, much to how users of the FSD beta program lose access to their advanced driver assistance systems when they drive carelessly. Additionally, he said that since Tesla gathers more data from interventions, the business gains more insight from drivers who actively correct the motions of fully autonomous vehicles. In 2022, the Tesla Energy company saw notable growth despite economic uncertainty that resulted in a decline in Tesla shares. Given this, Stevenson anticipates significant income growth from the Tesla Megapack, which safely and dependable stores electricity for their system, doing away with the need for gas peaker facilities and assisting in the prevention of outages. Based on my projection, Tesla Energy will experience significant revenue increase from Megapack XL when the new Lathrop facility starts up and the 2023 incentives start to apply. Tesla said that each unit can store more than 3 megawatt hours of energy, which is enough to power an average of 3,600 houses for an hour during the Q3 results call in October. Tesla's CEO Elon Musk said that the expansion of stationary energy storage is actually occurring at a rate of 150 to 200% each year, which is a lot faster than the growth of autos. Among other stationary energy storage systems, Tesla Energy, the company's energy division, installs solar-powered roofs, Powerwalls, and Megapacks. In the most recent quarter, energy storage deployment hit at a record high of 2.1 gigawatt hours, according to its shareholders' letter. Although the energy business remains more affected by semiconductor challenges than the automotive business, Tesla disclosed information about record energy storage deployments in Q3 that climbed by 62% year over year to 2.1 gigawatt hours, the highest amount we have ever attained. Even so, we were still able to develop to this degree because there is still a greater demand for our storage products than we can meet. Tesla is raising output at its 40 gigawatt hour Megapack factory in Lathrop, California, in response to the growing demand. During the results call, Tesla's chief financial officer, Zachary Kirkhorn, stated that the company's record-breaking sales of its Megapack and Powerwall products were the main factor in the company's highest gross profit to date. Strategic price reductions by Tesla will stop the growth of earnings per delivery in 2023, but earnings dollars will increase due to more deliveries. Tesla's earnings per delivery are among the best of any car maker, let alone an EV producer. He continued by saying that the reason earnings per delivery aren't declining more is because the Berlin and Austin operations are growing up, which results in lower expenses per delivery. Fremont is also losing market share globally and has the highest cost per vehicle. The more vehicles you make each week, the harder it is to deliver every vehicle by the end of the quarter. Stevenson showed how the end of the wave affects Tesla's completed goods inventory level on a different graph. Furthermore, Stevenson noted that while sales per vehicle decreased in 2021-2022, Tesla's automotive gross margin, which does not include regulatory credits, grew during the same period. He believes this is an extremely difficult feat to accomplish. He believes that although sales may decrease in Q4, it should rise in 2023. An in-depth graphic provided by a Tesla expert showed how revenue has grown over time. I forecast revenue to hit a new high in Q4 of 2019, more than $25 billion more than the total revenue for the year. 2019, in the tweet, he said that some Tesla believers like to claim that primarily due to CEO stock pay, Tesla must be a fraud because operating expense figures aren't rising quickly enough. He then tweeted saying that Q4 2021 in particular had a one-time payroll tax of $340 million for Elon's 2012 stock compensation exercise. The rest of the conversation on Twitter from Relatedly, there are some intriguing parallels between the belief held by certain analysts that Tesla stock is the greatest investment for 2023 and the worst year ever that ended in late December. In addition to a number of more comprehensive drawings of Tesla's deliveries, revenues, and earnings, Stevenson offers a number of charts outlining his prediction. Equity researcher Ben Callow reduced his target price for Tesla from $316 to $252. Subsequently, Kellogg praised Tesla as the best option for investors in 2023. Even while 6 analysts have already cut their price forecast for Tesla shares, the majority of them still have buy and outperform recommendations, and the objectives are still far higher than the stock's current price. Callow states that investors shouldn't be overly concerned about a decline in demand during the first half of 2023. The analyst claims that among other demand levers, Tesla can improve auto leasing and offer more potent incentives. Callow said that Tesla is in the best position in the automotive business as electric vehicles continue to dominate the market. Wedbush analyst Dan Ives, who has long been upbeat about the EV powerhouse, shares market bears positive prognosis for Tesla shares. Ever since Elon Musk took over Twitter, Tesla Bull has expressed concerns about the CEO on a regular basis. Analysts claim that Tesla investors are suffering as a result of the billionaire's remarks and the news coverage surrounding him. Musk has engaged in political discourse and exchanged tweets with users from many political perspectives. It would be easy for us and other bulls to lose up at this point and believe that the short-term headwinds are too strong to overcome for the stock to perform well in 2010-23. The analyst continued, Ives referred to Musk and Tesla's Twitter endeavor as a disaster and a soap opera that is hurting their brand. Ives reduced his price target for Tesla stock last week from $250 to $175 while keeping the share price at an outperformed level. Ives is yet upbeat in spite of everything. Ives did not say that the reaction to Musk and Twitter was responsible for 70 of the recent, sell-off in Tesla stock. But he did write that the financial community will closely monitor any more strategic errors made by Musk and that they will have a negative effect on shares. Overall, it is still advisable to keep a careful eye on Tesla stock, especially since it is still too early in the year to make any meaningful predictions. Remember to subscribe to our channel in order to get updated about Tesla stock.